As many of you know, the Emerging Issues Task Force, or EITF, met in March to discuss several open issues, one of which was Issue 12F, which deals with the recognition of new accounting basis in certain circumstances, commonly referred to as pushdown accounting. I'm Jim Simon, and I'm happy to be joined here with my colleague, Arturis Spencer, a senior manager in KPMG's Department of Professional Practice, who is part of the team actively following EITF issues. Over the next few minutes, we'll provide you with a high-level summary of the background and the current status of the issue of pushdown accounting. So with that, I know this issue of pushdown accounting has been around for quite some time. Arturis, can you provide us with the background and scope of this issue?
Certainly, Jim. So pushdown accounting really relates to an acquired entity adjusting their books and records to reflect the basis of the acquirer. Consistent with purchase accounting, the acquirer's basis in the assets and liabilities are typically recorded at fair value, and those values are pushed down to the acquired entity. So currently under U.S. GAAP, there's very limited guidance as it relates to pushdown accounting, and some of the more widely used guidance that's out there today comes from the SEC. Now, if you think about the SEC's guidance, it really outlines three situations. So in a situation where an acquisition results in an entity becoming substantially acquired, which is defined as an acquisition of 95% or more of an entity, pushdown accounting will be required. And then in instances where an acquisition of 80 to 95% of an entity occurs, pushdown accounting is permitted. And in situations where less than 80% of an entity is acquired, pushdown accounting is prohibited under the SEC's guidance. Now, obviously, this SEC guidance is not mandatory for non-registrants, so there's an inconsistency in practice as it relates to pushdown accounting for non-registrants. Additionally, in situations where registered entities have acquisitions that are in that 80 to 95% range where pushdown accounting will be permitted but not required, inconsistencies also exist in practice. So as a result of these inconsistencies and the lack of guidance, the EITF has been looking into this issue, and more specifically, as it relates to when and at what threshold pushdown accounting should be required, optional, or prohibited.
Okay, Arturis. So I think we now grasp the concept, but maybe you can walk us through a brief example of how pushdown accounting will work in practice to really drive this point home.
Sure thing. So let's assume that your company, and we'll call that company Company X. So Company X is acquiring Company Y, and at the date of acquisition, Company Y's fair value is $72 million. Company X plans to acquire only 70% of Company Y, and its equity is consistent with the consideration paid of $50 million. So let's suppose immediately prior to the acquisition, Company Y's book equity was $10 million, and subsequent to the acquisition, Company Y plans to continue to issue separate standalone financial statements. If pushdown accounting were applied upon a change of control, Company Y would be required to write up their assets and liabilities to that acquisition date fair value of $72 million.
So Arturis, in this example, it appears that Company Y applied pushdown accounting even though Company X only acquired 70% of Company Y.
That's correct, Jim. So this will be a difference from current practice, at least from a public company perspective, where in an acquisition of less than 80%, pushdown accounting is prohibited under the SEC guidance. But irrespective of the level at which pushdown accounting is applied, this concept will be the same. But your question really highlights one of the focal points of this issue, which is when and at what level should pushdown accounting occur.
So on that note, Arturis, what is the EITF's current position as it relates to pushdown accounting?
Well, as you may recall, that at the previous EITF meeting in November of 2013, the EITF discussed 4 alternative views for pushdown accounting, and at that time, the task force tentatively decided that pushdown accounting should be optional for all entities upon a change of control event and required for public companies when an acquired entity becomes substantially wholly owned, though no consensus for exposure was reached at that time. During that meeting, the EITF also requested the FASB staff to perform additional outreach to determine situations where pushdown accounting should be required or prohibited when it is otherwise optional. In response to the EITF's request, the FASB staff hosted a working group meeting in January of this year to discuss pushdown accounting. Members of this working group included accounting firms, preparers, SEC staff, the FASB board, their staff members, and the EITF chairman. The feedback received from this working group meeting was considered in the discussion at the March 2014 EITF meeting. But the real highlight from the March EITF meeting was that the task force reached a consensus for exposure on the issue of pushdown accounting. At this meeting, the EITF discussed 3 alternative views for when and how pushdown accounting should be applied. The first alternative was that pushdown accounting would be optional for all acquired entities following a change of control event. Now, this particular alternative was favored by most of the EITF members because of the optionality that it provides, and more specifically, that it allows the decision to apply pushdown accounting to be made by the acquired entity, which should be based on the needs of the entity's financial statement users. Now, if you think back to our example, this approach would be more consistent with the facts presented in that example. The second alternative discussed was that upon a change of control event, pushdown accounting would be optional if an entity was a private company and required if the acquired entity was a public business entity. This alternative wasn't discussed heavily and it received very limited support. The third alternative was that pushdown accounting would be required when a public business entity becomes substantially wholly owned and will be optional for all acquired entities following a change in control event. This approach is more consistent with the current SEC guidance in instances where an entity is substantially wholly owned. However, this expands the SEC's 80 to 95% threshold for when it's optional to apply pushdown accounting to all change in control events that don't meet the substantially wholly owned threshold. While this approach is essentially where the EITF ended their previous discussions on pushdown accounting in November of 2013, during the March meeting, there was very little support for this alternative. The EITF reached a consensus for exposure based on alternative 1, where pushdown accounting would be optional for all acquired entities following a change in control event, and they tentatively decided that there were no situations that would preclude or require pushdown accounting when it was otherwise optional. This consensus for exposure allows an acquired entity to make the decision whether to apply pushdown accounting at the transaction level rather than being an accounting policy election. Entities that elect to apply pushdown accounting following a change in control event will be required to apply the disclosure requirements in Topic 805 in order to enable users to evaluate the nature and effect of pushdown accounting. This consensus for exposure proposes a prospective transition approach. So just to wrap up, the FASB ratified this consensus for exposure at their March 26th meeting and decided to expose the proposed update for public comment for a period of 90 days. The FASB staff has started the process of drafting this proposed update. So with that, I would like to thank you for your time and inform you that for additional podcasts and other thought leadership publications on current EITF issues and the latest information on other financial reporting topics, please visit the Financial Reporting Network by using the web address on this slide.